Welcome to our channel, where we dissect trading techniques, strategies, and theories to make you a more skillful and proficient trader. Today, we are diving deep into one of the most common and widely used technical tools in trading, Fibonacci retracement and extension. The Fibonacci sequence is a series of numbers where each subsequent number is the sum of the two preceding ones, usually starting with 0 and 1. Thus, the sequence begins with 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on. This pattern was introduced to the West in Leaderboard, a 1202 book written by the Italian mathematician Leonardo of Pisa, who is also known as Fibonacci. You might be wondering how a medieval mathematical concept found its way into modern trading. The answer lies in the golden ratio, which is approximately 1.618, a unique number derived from the Fibonacci sequence. This unique number manifests itself in a diverse array of natural and human creations. It's found in the spiral designs of seashells and galaxies, the arrangement of leaves and flowers, and the proportions of iconic architectural feats, as well as in the balanced compositions of renowned artworks like the Mona Lisa. Notably, this intriguing ratio also reveals itself in the financial markets. The adoption of this concept in trading began when traders noticed that asset prices often retraced or extended by percentages closely related to the golden ratio. This observation led to the innovation and development of Fibonacci retracement and extension tools. These tools offer traders calculated levels that serve as potential points of support and resistance. They are instrumental in helping to identify possible reversals, breakouts, and other significant price movements. Markets tend to respect these levels not because they possess some magical power, but because they are universally recognized and utilized. As a result, many traders look at these same levels to make decisions, making them self-fulfilling and therefore more significant. Fibonacci retracement. Fibonacci retracement involves using horizontal lines to indicate possible levels of support or resistance at key Fibonacci levels before the price continues in the original direction. These levels are identified by marking the highest and lowest points of a significant price movement on your chart and dividing the vertical distance by the key Fibonacci ratios. To measure the retracement, consider the lowest point as 0% in an upward impulse and the highest point as 100%. Conversely, for a downward impulse, consider the highest point as 0% and the lowest point as 100%. The key Fibonacci ratios are most commonly 23.6%, 38.2%, 50%, 61.8%, and occasionally 78.6%. However, it's essential to highlight that the most critical area to focus on lies between 38.2%, 50%, and 61.8%, often holding significant importance in identifying potential support and resistance levels. This area is where traders should pay particular attention when analyzing price movements. For example, imagine you're observing the Bitcoin price, which has been in a strong upward trend, moving from $20,000 to $30,000. After applying the Fibonacci retracement tool, you find that the 61.8% retracement level is at $23,820. If the price starts to pull back, this level could act as a strong candidate for support, where you might expect buyers to step in. Fibonacci extensions. Fibonacci extensions, on the other hand, help forecast how far the price of an asset may travel after a retracement or pullback is complete, essentially targeting the future price movement. Fibonacci extension levels are identified by marking 3 critical points on the price chart. For an upward impulse, the initial swing low and the subsequent swing high before the retracement should be marked as part of the upward impulse, while the following swing low after the retracement is marked as the 0% of the extension levels. In contrast, for a downward impulse, the initial swing high and the subsequent swing low before the retracement should be marked as part of the downward impulse, and the following swing high after the retracement is marked as the 0% of the extension levels. The key Fibonacci ratios are most commonly 38.2%, 50%, 61.8%, and 100%. Additionally, for longer-term projections, some traders also incorporate 161.8%, 200%, or even 261.8% into their analysis. Let's circle back to our previous Bitcoin example. The price retraced to $23,820, hitting the 61.8% retracement level. Assuming you observed increased buying momentum, you plot a 161.8% Fibonacci extension level at $40,000 as your prospective target. When the price ascends and hits this $40,000 mark, consider this level as an opportune point for profit taking. This is because Fibonacci extension levels commonly serve as zones of resistance, where price reversals are likely to occur. While Fibonacci retracement and extension levels offer valuable insights, it's crucial to understand that they are not foolproof. They should not be relied upon as the sole indicator for trading decisions. The most effective way to use Fibonacci levels is to seek points of confluence with other technical indicators like moving averages, chart patterns such as the double bottom, candlestick patterns like the shooting star, as well as other forms of support and resistance like trend lines or horizontal lines. The goal is to find areas where multiple forms of analysis align, providing a stronger justification for your trading decisions and creating a more holistic market view. Thank you for watching this video. Feel free to drop any questions in our Telegram group, and we will do our best to provide answers. Engaging with fellow traders can also provide valuable insights and different perspectives. As always, trade smart, and we'll see you in the next video.